pending home sales increased by over 8% month over month and a 5.7% increase year over year. This is the largest pending sales for the resale of homes that we've seen in over 3 calendar years. Now look, what is the contributor to this? We all know that the Fed's lowering interest rate is the largest contributor to this. But listen, one of the biggest things right now is that buyers have been sitting on the sidelines. And I've been talking about this. It isn't that there's a lack of buyers. It doesn't mean that there's a lack of demand. It just means that buyers have conservatively sat on the sidelines for the last couple of years, waiting for mortgage rates to go down. Now, in spite of mortgage rates going up slightly over the weekend, it will halt home buyers temporarily. And I'll explain why interest rates went up over the weekend in just a moment and how that affects home buyers in the residential market, but how it really affects the commercial market here in just a moment. Now let's talk about single-family residential purchases right now. So if you're an investor, end user, and you're looking to go out and get a home mortgage right now, this is a great time. Interest rates are slowly starting to creep down in spite of mortgage rates slightly going up over the weekend. Now, one of the big things right now, guys, is you have to understand is that there is over 11 million home buyers in the market waiting on the sidelines to purchase homes. Problem is there's not enough inventory. So in spite of the housing market slowing because of high interest rates and the expensive mortgages, the average mortgage right now is down to $2,850 per month. So that's approximately a 5.7% reduction in mortgage rates month over month. Now, so one of the big things is that when money gets expensive, people contract. And right now, guys, with Hurricane Helene, Florida has contracted. So in spite of Florida contracting this past month, ending of October 6th, and with Hurricane Helene, the market in Florida has dropped. New home resales have dropped. And in spite of having one of the largest resale cities and one of the largest resale states in the nation contracting because of environmental circumstances, the rest of the market has picked up the weight of Florida contracting and still shows prominent resales in the up and coming months. Now, one of the big things is that U.S. Treasuries are up substantially. That means that the Feds are borrowing a large quantity of money. What else is new, right? The Feds are going out spending more money at the craziest time in history, right before the presidential election. So what most people don't know that in spite of interest rates going down, when treasuries go up, lending gets harder. So investors, listen up. Let me explain something to you and what's happening to us in the multifamily sector. We just went through a loan right now where we were going after a $28 million loan to build an apartment complex, just like the one right behind me. And so as we were going in to facilitate the completed documents on this loan, Treasuries raised, and they said, oh, hold on. Treasury went up. The amount of money that's now available to banks is limited. And so it restricts the amount of capital that banks can actually have to utilize for lending. So it means that leverage becomes a lot harder. So in spite of interest rates going down, leverage gets more challenging because the amount of capital the banks have for expenditures to lend on goes down because the Feds are spending more money. And so the bandwidth decreases. And so what happened was we took a $28 million loan and they said, we're going to reduce proceeds down to $25 million. Oh, P.S. by the way, we're not only just going to do that, we're going to take your interest reserve amount and we're going to hold another $2 million in interest reserve out of your proceeds, meaning that instead of getting that $25 million, which was a $3 million reduction, now we're getting $23 million and our proceeds went down by $5 million overnight because treasuries rose. So what's the result? How do we execute this? We pray, right? And so one of the big things is we can execute the loan, but it means that we have to come to the table with an additional $5 million in equity to be able to make that loan float and the project go. And so it's a last minute variation and variable thrown into the mix right before we finish facilitating the signatures on our construction loan. So now we sit back and say, let's halt for a moment. Let's hope that once we get over the cusp of the elections, that once we have a president elected, no matter who that president is, that Treasury goes back down. Treasury goes back down, proceeds go back up. So what right now we're sitting back negotiating with our broker and the lender saying, once Treasuries come back down, can we get back to our initial proceeds? And they said yes. And so understand that if you're an investor right now and you're taking a look at taking down a portfolio of real estate, multifamily, commercial real estate in any sector, whether it's retail, office, warehouse, multifamily, doesn't matter what sector. Right now, anytime Treasuries are up, understand that from macroeconomics, right, nationwide and worldwide economics, it changes the availability of revenue and capital that's available to you, the end investor, as leverage towards their projects. So it ended up taking our project from a 70% loan to cost down to a 58% loan to cost. And so when we do that, it costs projects because a lot of investors sit back and they just don't have a $5 million check to scratch and write to make the project go. So my partner, Kyle, comes to me and he says, hey, Jerome, how do we execute? Should we raise more capital? I said, I can go in and write a check for the difference. But once we sign on those loan docs, that money's tied up for the next 2 years at minimum. Because we got to build that product. We got to utilize our equity first. Then we start drawing on our construction loan. So right now, we sat back and said, let's wait 30 days, let's get post-election, and let's see if we can facilitate that loan in lieu of hoping that the Treasuries come back down so we can execute in a more aggressive fashion. That way our proceeds and leverage go back up. Leverage is already challenged and already cost investors. We know that. Well, we were getting 80% loan to cost on construction and 80% loan to value on value add assets. Now we know that we're going after about 65 to 70% loan to cost or loan to value on both stabilized assets or construction lending. So with that said, how do you take these down? Right now, guys, small projects are key. Don't go after big projects right now. Big projects are catastrophic when it comes to lending, high treasuries, high interest rates, and all the other variables that are available to you right now. Now, unless you have massive experience, a large bankroll, and the ability to execute or raise capital, small acquisitions are immensely profitable. I'll tell you, my East Taylor Street project in downtown Phoenix, it was 2 duplexes that were leveling. Small acquisition, 0.75 acres, 32 units of multifamily that we're going vertical with. We purchased the land cash outright, and the leverage alone, because of the acquisition, we're able to go in with bank lending with no additional money or proceeds out of pocket, and we're going to crush about a $3 to $4 million profit in less than 14 months, turnkey on a little 32-unit apartment complex. What that means for you guys is go after the 6-unit, the 8-unit, the 10-unit, the 12-unit, the 20-unit apartment complexes. And I'll tell you that there's not a lot of inventory out there, so the inventory that still exists is still expensive in spite of the current market. And in spite of values going down, end users and end owners are not giving up on their sales prices because they know what they have in their fingertips. Once interest rates go back down, cap rates go back down, the market stabilizes, and so they're not willing to let loose of some of these assets. Now, for those of them that are otherwise compromised because of fluctuating rate mortgages or other external circumstances, values are down. Inevitably right now, because of high interest rates and cap rates going up, values have been compressed. And because of that, there's opportunity in the market right now. Now, as interest rates slowly start to soften and they go down, along with mortgage rates, values will slowly come back up because buyers will back in the market, supply and demand will show its true colors and where we sit right now today. But ladies and gentlemen, as long as the treasuries are up and the federal government is spending money, it's going to be harder to get leverage and larger proceeds on your assets. As that happens, go out and buy land, build houses, crush down $200,000 profits, crush down $150,000 profits. Don't do the fix and flips that make you $30,000, $40,000. You can go in. You're going to land up spending the same amount of time to going after a brand new build versus a fix and flip that both take you 6 months. The turnkey new build can earn you $150,000 to $200,000, where a fix and flip on average is going to make you $30,000, $40,000, or $50,000. You could do 2 or 3 fix and flips, and you're going to have 6-time increase in return on investment with brand new builds in the same amount of time as doing fix and flips, and a substantially larger profitability than you will doing fix and flips. What does that mean? Do new builds, guys. As we get through this, take those proceeds and take down little 6-unit, 8-unit, 10-unit, 12-unit, 20-unit builds and crush out the multifamily and take advantage, P.S. by the way, of the best tax incentive that developers and investors have across the whole United States through cost segregation, which is depreciation of assets and bonus depreciation. Now, ladies and gentlemen, The market is starting to prime up. Are there caveats to the market? Are there still variables that are in our face? 100%. I will bring those variables to you. All you have to do is smash that thumbs up button and click and subscribe to our YouTube channel for more content just like this and for more market updates. And the market becomes more expandable, user-friendly for end investors like you and I will let you know. But right now, ladies and gentlemen, leverage is the issue. Let's pray for lower interest rates and continued reduction in cap rates so the values increase, but don't be a sideliner. Sideliners don't make money. You cannot score points in a basketball game, football game, baseball game, or any other sport sitting on the sidelines and in the bleacher. You have to be on the court and in the field. And so what I'm telling you guys is get off your ass, get off the bleachers, get in the game, and start investing in real estate. It's not whether you should or shouldn't be investing in real estate. It's how you invest in real estate. And yes, treasuries right now are high. Leverage is tough. But I gave you guys a roadmap and I gave you guys a business plan that when you execute, not if you execute, when you execute, you'll crush down profits. Ladies and gentlemen, click and subscribe, pound that thumbs up button, comment below. Let me know what your take is on the current market, and I look forward to seeing you next time.